Great, good afternoon everyone, and a warm welcome to everyone, including CFA Society members and candidates, INFINs and NZ Private Capital members and everyone else who's joined us today. My name's Zoe Wallis. I'm an investment strategist at Forsyth, Barr, and I'm your MC for today. And I'm incredibly excited to be chairing this session, speaking to a range of very well-educated and strong views around the table, given that it's an incredibly interesting time economy-wise and investment market-wise. Before I introduce today's speakers, I would like to just briefly mention the upcoming CFA Society New Zealand Investment Conference. So this is a full day event in Auckland on the 25th of May, and we have a great lineup of speakers scheduled for the day. So if you'd like more information or are keen to sign up, please head to the NZ CFA Society website and follow the links. Today's webinar will be recorded, so you can watch it later on the CFA Society YouTube channel, but we'll also email the link to you and include some information in the conference with that as well. So the topic of today's session is an economic update with a focus on investment conditions. Today, we've got three great speakers for you. We've got Paddy Brown, who's a Chief Investment Officer at Mercer, Bevan Graham, who's the Economist at Salt Funds, and Richard Sullivan, who's Principal Advisor at MBIE. So in terms of the format for today, each panelist is going to give their own short presentation, and then we'll have a Q&A and discussion at the end. So please submit your questions at any time using the Zoom Q&A function. Don't use the chat function, use the Q&A function. But we will hold questions until all three presenters have spoken. So first of all, I'm going to hand over to Paddy Brown, who's going to give us a bit of an overview about the themes and opportunities in global markets at the moment. Over to you, Paddy.
Thank you, Zoe, and good afternoon, everybody. Share my screen. So the last 12 months have seen a significant upheaval in global markets, the number of notable events having a profound impact on the world as we know it. Pandemic restrictions are now in the past, and the world has decided to live with COVID, but we still feel a fallout in the elevated debt burden and the fragility of the just-in-time production model. At the same time, regional conflict has further exacerbated supply chain stresses and led to higher food and energy prices. Elements of these experiences echo those in the 1970s, another period that started with the aftermath of a severe virus, in that case the influenza strain H3N2 or the Hong Kong flu, and the conflict-induced shocks in the energy complex. In that case, it was Nixon's support of Israel in the Yom Kippur War, which caused a swift and lasting retaliation from OPEC and led to almost a decade of energy rationing. Investors then, as now, face the challenges of investing during periods of inflation, Cold War, and decoupling, which leaves us with a sense of deja vu. We're not in precisely the same place. The current challenges is prices twinned with a wider sustainability crisis, which is accelerating physical damages from climate change and biodiversity on the brink. But I think we're in a better place to find solutions to this crisis, with many renewable technologies having gained the critical mass that they did not have in the 1970s. This presentation here would construct a theme of which reflects the lessons from the past. Investors, we think, stand the best chance of long-term success by learning from the past. And today's investors arguably have greater degrees of freedom to play with than their 1970s counterparts. So I'm looking at this really from a global thematic presentation, a global thematic perspective, and coming up with some ideas which we can then throw to the broader group for discussion. So at inflation more generally there. So the inflation playbook from the past. Inflation has been one of the driving themes and concerns for investors over the past 12 months, as we've seen from the significant sell-offs in markets. Even if many believe that inflation is now beginning to slow, it's unclear how long it will take to return to a level that resembles central bank targets. A number of factors suggest that the challenges of the current inflation bout are far from over, and that inflation risk has increased in the long term. For example, globalization is likely slowing and moving towards fractionalization. Policymakers may be tempted to keep interest rates lower than inflation to reduce the debt burden over time at the risk of runaway inflation. Significant challenges exist with respect to the energy infrastructure, security, and electrification, particularly in Europe. Price increases as a result of higher wages, the so-called wage price spiral, could continue, although union power has declined significantly since the 1970s. Trends in pricing of consumer electronics and improvements in storage and processing power appear to have been flattening out, although AI and quantum computing could eventually pull prices down. The tech deflator has long been a long-term anchor for inflation. You see here some of the inflation scenarios since the 1940s through to today. And as you can see there on the right-hand side, while inflation has been different types of inflation through these periods, the effect on national resource equities and the S&P market in general has been very, very different. So, sometimes listed equities or natural resources have been a inflation sensitive way to play inflation. Other times they haven't been. So, we've seen very, very different scenarios through there. But, we think this time, inflation may benefit, portfolios may benefit from a shift to short-term price movements to longer-term inflation-sensitive revenues. So companies with inflation-sensitive revenues should do pretty well in this environment. Natural resource equities, in particular, are likely to have a role to play here. And they're also stocks which are very useful in the energy transition. And we'll see later on in the presentation how much more mining we're going to need if we are going to have a sustainable energy transition. And the return of real yields has elevated the role of index-linked bonds in managing these risks. Balance of power here is pretty critical as well. And as we've seen with the emergence of geopolitics, or the very unwelcome emergence of geopolitics, has had a massive impact on markets over the past year or so. And the parallels with history, specifically the 70s, can again be applied to current geopolitical and social dynamics. So, as I mentioned earlier, in 1973, President Nixon proposed providing military aid to Israel during the Yom Kippur War. And the result of that was an Arab oil embargo that forced the Western world to economize for the subsequent decade. Admittedly, several positive developments came on the back of this, with the birth of many renewable technologies, energy demand reduction technologies, and supporting policies to address the challenges posed by the embargo. Today, there are some similarities to that dynamic, with the Russian-Ukraine conflict impacting supply chains and forcing Western countries to consider much-needed evolutions to energy provision and infrastructure. Other threats to the balance of power as we know it are the trends of dissatisfaction and inequality that we're seeing within society. Inequality is now at pre-World War II levels, with 14% of income flowing to the bottom 50% of society, while 19% goes to the top 1%. Global unhappiness has been at all-time rise, and these levels of dissatisfaction are potentially related to polarization over economic and cultural issues. At best, this polarization can increase the risk of unconstructed politics or novice governments, and at worst, increase the risk of internal and/or external conflicts. With little immediate prospect of these trends being reversed, investors should be prepared for more volatility driven by political and geopolitical forces. Some key takeaways from this section. Some clear parallels between the geopolitical tensions and resulting challenges of today and those of the 1970s. We appear to be entering an era where globalization devolves into fractionalization, with higher risk of conflict, whether fueled by increased social inequality and dissatisfaction. In this volatile environment, investors can benefit from scenario analysis, stress testing, extending to event-specific fire drills. And I think we need to see a lot more of those to make portfolios resistant going forward. I think there's a lot of debate around the value of the 60-40 portfolio as we have seen over many years, and for investors to kind of think that we can go back to that 60-40 portfolio again probably does need a little bit of testing, given the ongoing stresses that we are seeing on equity markets around the world. So Transition, I think, is absolutely key. That's something that we are seeing at the moment, and this is a global thematic. So in the 1970s, we had the oil embargoes, and economies were forced to try and economize, use less oil, and some of the real changes that we saw in society there were, the increase in hydro power. But today, I think we've got a lot more toolkit at our disposal. If we look at the different sources of energy and renewable energy available to invest in, and to help the world decarbonise, as well as move away from a reliance on fossil fuels, and have more local energy production. But what we saw in the 70s also was the emergence of Japanese cars, and much more fuel efficient technology in terms of automotives, and we're seeing far more availability today of technology to help us to use this energy, and to use energy in a much more carbon efficient format. But you can see there on the right hand side of my presentation, just some of the significant increases in mining, which is going to be required for this energy transition. So it's, while the idea is a green future, we're going to have to be heavily involved in mining for a very long time to achieve this transition. So you can see that there's 6 times more minerals used in electric cars compared to conventional cars, and minerals that are used in clean energy technologies compared to other power generation sources are up to 13 times more. So mining is with us for the foreseeable future. So the commodity complex is also very tangled, and we've seen with the Russian invasion of Ukraine, both countries being very large fertilizer exporters. That's had a massive impact on food price inflation globally, and food price inflation is likely to persist into next year, and bring with it more geopolitical instability. Weather events, as we've seen recently close to home in New Zealand, and water shortages are also further challenges for food. But with the ramp up in agriculture, we've got to be cognizant of potential impacts on biodiversity, and some of the negative externalities that we are seeing in the biodiversity space. And this is really starting to become as a new thematic in sustainable investing also. We've agreed about carbon reduction targets, but biodiversity is now becoming a very, very strong theme in sustainable investment. Forestry as well is looking like a pretty attractive investment in the foreseeable future, if we can get around some of these biodiversity issues here. But many see forestry as a preferred solution for carbon capture and storage. But timberland has to be managed in the right way to not impact biodiversity, and to avoid pathogen risks, climate change risks, burning forests, and so on. Cross-laminated timber, as we're seeing in the real estate space, is emerging as a potential super material for construction. It can outperform steel, concrete, and fire resistance tests. And we are seeing increased plantations globally to meet some of this demand, as well as provide carbon sinks. Looking at what investors are actually wanting, and CEOs are caring about on the right-hand side. So the first survey on the left-hand side looks at the top environmental and social themes that Australians care about when investing, from a responsible investment organisation. And you can see there that we are starting to see companies and investment firms like ours really being asked to start focusing on a sustainable future. And this is becoming a lot more mainstream. The same thing when you're looking at surveys of CEOs through the World Economic Forum survey. Most of the concerns over a long-term period are due to failure of environmental factors. So again, investors are needing to engage significantly on what a portfolio might look like in a decade's time. Companies that fail to address their negative social and environmental impacts are likely to see their valuations come under pressure from investors over time. In a world which is transitioning fast and yet still needs to move faster, investors can and should use their voting power to influence change and drive and progress on ESG matters. It's important that investors develop their own engagement principles, perhaps through ESG workshops and those principles translated into tangible objectives that can be measured via portfolio analysis, e.g. looking at emission scores, ESG ratings, and so on. I think that the world is a complicated place at the moment, as we've discussed, and you really want to set your portfolio up to capitalise on some of these dislocations in the market. So COVID, inflation, energy challenges, the risks of the new era. One with us as fiduciaries, we need to work smarter and more creative to deliver successful investor outcomes than we have previously. We see it becoming a provider of liquidity, in stressed or dislocated situations is an important toolkit to have. And the ability to pivot towards credit dislocations, special situations, distressed debt, and opportunities in the cycle are proving to be pretty attractive at the moment. And finally, we're seeing high yield is actually living up to its name, for the first time in a decade. So I think investors really need to speed test the governance process in this environment. Investment opportunities can be fleeting, so you need to be nimble and able to take advantage of those opportunities. You need to think about the ability to have cash during a crisis if you want to capitalise on market dislocations. And you need to move relatively quickly. Timeliness is a critical factor to benefit from opportunistic ideas. How can you streamline your decision-making processes? Obviously, hedge funds are well placed to capitalise on this high volatility environment, but also institutional investors and wealth investors who can be dynamic and can move away from a rigid framework will be well placed to take advantage of the current dynamics. I'll just leave it on a last slide here to get you thinking that diversification really is your friend. Set and forget might not give you the best outcomes. Commodities were the best performing asset class in 2022 at 16.1%. But if you've been in commodities for the last 10 years, your portfolio would have gone back by 1.3% annually. So you need to work with your financial professionals and have well-diversified portfolios and be aware to the thematics we're seeing in the markets. And back to you, Zoe.
Thank you very much, Paddy, and we'll come back with some questions for you at the end. I'll now hand over to Bevan to chat us through some of the New Zealand implications from what Paddy's just talked about.
Excellent. Thank you, Zoe. And look, some great slides there, Paddy. The bad news, folks, is that I don't have slides, so you're just going to have to look at me for the next 9 minutes. But look, what we are facing into, as Paddy's mentioned, a lot of pretty big global challenges, and look, Paddy's been through all of them, really. The end of globalization. Some others that we might add in would be the fact that we see the end of the era of China acting as a major disinflationary force. We've talked about infrastructure deficits and resiliency, high debt levels, demographics. We've changed our view on the demographic outlook, and this might be one to revisit in Q&A, Zoe, but the conventional wisdom is that, demographic challenges are typically disinflationary. When you think about the recent history of Japan, we've changed our view on that. And of course, other things, really poor productivity, geopolitical tensions rising, so that we are facing into a global environment where we think growth is going to be significantly lower going forward. We think inflation is going to be higher going forward. We think interest rates also are going to be higher. Now, look, that's not necessarily a bad thing. We can think about the fact that we're going into this environment now where cash rates are around 5%, and some of you younger people out there might sort of be thinking that's a bit of a new normal. But some of us with grey hair think about that as just going back to the old normal. Really, and this period of ultra low interest rates has really been a bit of an experiment. Those low interest rates for so long have led to some pretty poor outcomes, really. Asset price inflation, which is fine if you're an asset owner, but if you're not, we've seen rising inequality on the back of that. And look, even poor corporate behaviours, as we're seeing playing out with Silicon Valley Bank at the moment, just a function of that very low interest rate environment that we've seen for many years, and the costs of that are going to continue to be exposed over the next few years. We've got pretty big fiscal challenges to meet, and we're entering into this more fractured, fragmented global environment. So that there are three issues in that environment. There are three issues that I want to focus on in particular for New Zealand. And the first one really is trade. So, you know, we are a trading nation. We rely heavily on imports and exports. And look, the global trading environment is becoming considerably more complex. Globalization is in retreat. Political leadership around the world is buying into the anti-globalization rhetoric, and we only had to see that in 2016, a watershed year, really, with the election of Donald Trump and the UK's still inexplicable decision to vote for Brexit. So look, in that environment, you know, we need to ensure, you know, diversification of our trading partners across the, you know, the increasing geopolitical factions that are going to emerge over the next few years. I mean, imagine a situation whereby China does invade Taiwan, and the same sort of sanctions are placed on China as have recently been placed on Russia. And that would leave us in a pretty problematic situation. So trade is a big one. I lose sleep over that. I also lose sleep over fiscal policy. I know, pretty boring, but you know, I do lose sleep over it. Look, the good news on this though is that we are actually in pretty good fiscal shape in New Zealand, and look, we need to be, given our size and place in the world. So look, we're in a pretty good starting position, if you like, to face into the massive fiscal challenges that are ahead. And it's notable that this is an election year. And so we're going to hear a lot of politicians making a lot of promises. And those promises will all go along the lines of something like this list. A commitment to quality public services, to fix the infrastructure deficit and build back better with more resilient infrastructure, fix inequality, both on income and wealth, maintain current arrangements for pension entitlements, meet our net zero commitments by 2050. Some may even promise lower tax cuts, and we're going to do all of this while maintaining prudent debt levels. That's a pretty hard circle to square, in my view. There are huge calls coming on the public purse. And look, even in the recent environment in New Zealand, there has been, you know, calls on the New Zealand government to use its balance sheet more effectively. For example, to use that very long period of very low interest rates to invest more. But look, we need to keep that fiscal buffer for when emergencies are required. And look, we've seen that needed 3 times over in short and pretty quick order: the Canterbury earthquakes, COVID, and now, of course, with Cyclone Gabrielle. So look, certainly use the balance sheet to fund the rebuilding or the fixing of whatever is required to be fixed, but we need to restore that buffer for the next emergency. One commentator recently argued that the government should be giving up on its ridiculously low debt target. Remember, if we have ridiculously low debt, we've also got ridiculously low debt servicing costs. And think about it this way: if you're America and you've got federal debt around 100% of GDP, and the average interest rate is 3.5% on that debt, then you've got 3.5% of GDP going to debt servicing every year. So at any use of that buffer, without any intention to restore it, that means we only get to use it once, and we've got to work out what that once would be. Look, a better, more challenging position for us in New Zealand is to have the conversation, or do a better job of the conversation around what our fiscal priorities are. And that means stop having conversations about individual policy positions in isolation and actually start talking about them together. I was listening to the radio, you know how you do, you know, coming home from work and you turn on the radio and you get really angry. Well, I did that the other day. You know, it was two stories back to back on Radio New Zealand. And one of them was the Retirement Commissioner arguing for the continued commitment to current New Zealand superannuation commitments. The very next story, a second story, a separate story, was about our failure to make progress on reducing child poverty. Well, I would have thought that a more interesting story might have been a discussion of one story and a discussion about the relative priority or ordering of those priorities. And look, failure to have that conversation and make the hard calls makes taxes ultimately are going to have to rise. And look, we're seeing that in the US right now. The debt ceiling has been reached. President Biden's new budget proposes increased taxes for the wealthiest Americans. That won't happen because there's a fractured Congress and fiscal tensions will just continue to build. This is going to be a long and arduous process. You know, here in New Zealand, we currently have the means to avoid that same sort of set of unfortunate circumstances that most of the developed world actually is facing into right now. The third thing I wanted to talk about is another often talked about by economists, and you can see people's eyes glaze over as soon as you start mentioning it, and that's productivity. You know, this is not a New Zealand, just singly a New Zealand problem. This is a global problem. And look, you know, think about GDP for a second. You know, it's generally acknowledged that GDP is a pretty poor measure of economic well-being, but it's the best we currently have. That said, I think we do tend to focus on the wrong GDP measure. We should be looking at total GDP versus per capita. Per capita GDP is a far better measure to be looking at in terms of our well-being. It removes the population changes, obviously. You know, if you look at that period 2000 to 2019, so pre-COVID, GDP at 3%, per capita GDP at about 1.5% per annum. And the key reason for that is that very low, long-standing problem of very low productivity in New Zealand. As Richard will tell us, there's really no silver bullet to fixing that. There's a whole lot of incremental policy changes that need to happen to fix that particular problem. But I do want to talk about it in the context of immigration, in that we're seeing currently very strong, I'm just going to have a sip of water, very strong migration inflows. And we saw that today with the annual rate at about 30,000. So we're back to very strong inflows. Look, immigration's always going to be the answer to immediate skills and labour shortages, but it's never going to be the long-term answer. So using just importing people, especially for low-skilled work, is negative for labour productivity. But look, it's also negative for capital productivity. If you're building populations, low-skilled population, then those people all need to be housed. If we continue to use a significant proportion of our capital base for housing and housing-related infrastructure, that is not very good for capital productivity. So look, in summary, some pretty big challenges out there in the world at the moment. We've got our own unique set of challenges and risks here in New Zealand. We need to manage them pretty carefully. But in terms of investment implications of that environment that we're going into, look, I think it is going to be potentially more volatile, and that argues for greater active management of your portfolios. Look, I think the future holds a more challenging environment for equities, but right for active investors, as some sectors are going to perform better than others at different points in the cycle. More volatility means more cycles and greater opportunity to add value through more frequent sector rotations. Sovereign bonds are going to be challenged by higher inflation and those rising debt levels. But I think, as Paddy mentioned also, you know, timely exposure to a well-diversified credit portfolio, you know, as the cycle permits, is going to be a key part of the future investment environment. And exposure to green bonds to capture the benefits of that transition to a greener planet. Portfolios are expected to benefit from an increased exposure to asset classes that we would expect to perform better during periods of low growth and high inflation, and that is infrastructure and property. But look, also need to find and continue to look for those thematic and uncorrelated asset exposures that will help from time to time also. So look, I'll leave it there, Zoe, and hand back to you.
Great. Thank you very much, Bevan, and thank you to everyone who's already posted some questions in the Q&A section. I'm just going to now hand over to Richard to tie us off with talking about the future shape of New Zealand economy. Over to you, Richard.
Thanks, Zoe, and thanks, Bevan, for sorting out my work program for the rest of the year. That sounded like we'll be busy. Just want to highlight that the Chief Economist unit here at MB, while we do have a monitoring function, we don't do economic forecasting or macro advice. Our main focus is looking at emerging and enduring issues and coming up with research and hopefully some decent policy advice on those. So things that we do look at. Where are we? So we start from the big global mega trends, and apart from climate change, we also have things like massive demographic change around the world, aging and population growth in itself, and where they're moving to. Most of the world is rapid urbanisation, and also we've got quite a lot of technological breakthrough at the moment, like lots of new technologies on how we deal with that. And importantly, the shifting economic power. We're seeing the centre of economic geography move east and south, and that will have quite an important impact on New Zealand. For New Zealand, these, we're not immune to these. We also have quite a lot of these effects happening to us. So the demographic change with the ageing population, we definitely see that in the future our population will be larger, older, and more diverse. The impacts of climate change and technology will affect significantly influence how we live, where we live, how we work, and where we work. Urbanisation, while it's a global issue, it's unknown in New Zealand. With the technology, the potential is that our population becomes more dispersed as technology and cheaper house prices mean people can live in the regions and work for city salaries and things like that. So that will have its own challenges in terms of infrastructure and health and education provision. And as we've seen, if we all decided to move to Gisborne because of the nice surf, your infrastructure is very much at risk. And it will take a lot longer for it to come back than if, say, Auckland had a road cut off. The ageing population will definitely have an impact on our fiscal balance sheet in New Zealand. It will likely be an expense. But for most of the developing world, an ageing population actually means there'll be more people of working age. And so, like Bevan said, that might actually be inflationary, as there's more demand for the goods that working age people will demand, and therefore put more pressure on resources. And I think the other thing we need to note with these megatrends is things like the current cost of living crisis. That has its roots in some of these megatrends, like the technological change to just-in-time delivery, and the supply chains getting very, very tight. And then when there were breaks or bottlenecks in the supply chain, we saw that goods became very hard to come by. And likewise, food prices, as we see climate affect crops much more regularly, adds to prices. And then we have to think about what it means in New Zealand, like how will we adjust to these future challenges? And we always go back to New Zealand's comparative advantages. And if we look at New Zealand's comparative strengths, they do reflect very deep roots factors. And agriculture and biological sciences are what we're very good at, and products related to agriculture. We're known for lamb and milk and wool and things like that. And it reflects a climate that's conducive to agriculture. It's likely that that will remain, and so this will likely be a persistent strength in New Zealand. And compared with other countries, New Zealand's institutions are a definite strength. We have very high trust and transparency in the fundamental institutions of our government, like our Fiscal Responsibility Act, our Reserve Bank Act, and the trust we have in the public service, which you may disagree with, but compared to other countries, it's very high. And these are very important in terms of how you develop policy and how easy it is for businesses to get started and to get up and running and try new things. And the other important thing that New Zealand has is we have very high subjective well-being, and especially when you compare to our income levels and our GDP levels, as we punch above our weight in terms of quality of life, that self-reported quality of life. And we don't really know exactly why that is, but there's something about people living in New Zealand where they feel they're better off than their incomes would suggest. I mean, theoretically, you can go to Australia and earn 30% more tomorrow, but actually, people report that they feel better about their lives in New Zealand, slightly higher than in Australia. And when we look to the future, these fundamental deep roots factors of our strengths are probably what's going to drive where our new economic opportunities come from. They're likely to be adjacent to agriculture or adjacent to our climate or adjacent to our strong institutions. But we should always be aware that adjacency is not always obvious. For example, these security, your office security systems are basically electric fences from farms. And of course, Nokia phones were basically a forestry communication device. So it doesn't, just because we're agricultural doesn't mean that the tech opportunities don't exist. But we will need to change some of the things that we do. And it will require some sort of business model innovation, which both Paddy and Bevan alluded to. And the productivity issue is, as Bevan suggests, it's necessary but not sufficient. We need more productivity to do better. We need doing better things. I'll come back to that. Our traditional idea of going for growth or more productivity is not enough. We need to decide what we need the growth for or what we need the productivity for. If we just become wealthier but it does not improve our well-being, was it really worth it? Or if we produce more stuff, it has to be delivering a better well-being outcome. And so our volume-based low productivity is the structural issue that we need to think about. And the two ways of improving productivity is doing things better, which is traditional, that's your dynamic productivity, but it generally just means more of the same, and quite often more of the same, but for lower cost or lower inputs. But that's not going to fundamentally change the way that you deliver the economy, like for a more sustainable or an inclusive future. You really need doing better things, which is a more disruptive style of technology. It's also of productivity change. It's also the one that's very hard to imagine or predict. As I said, productivity is necessary but not sufficient to achieve these things. And one of the ways that we think about changing the direction of GDP growth is that we need new business models, and we are seeing it develop. And Bevan and Paddy will probably show you that there's lots of firms that are much more purpose-led. They live by their ESGs and things like that. But what that shows is that they are delivering things as well as, or rather than instead of, more profit or more productivity. And it's driving a direction of activity. And we find that that's the sort of thing that we really need to deliver more in the wider economy. The appetite for change is high. We are seeing many countries around the world introducing lots of recognising the need for the broadening of their economic model, and there's some more, as well as emission standards. We're seeing much more circular. We're seeing, especially in Netherlands, but we've also seen in Japan, China, and Chile are requiring much more circularity within their economy. There's not only waste reduction, but it also means that you have a resource available for use without having to go back to the mine, so to speak. And there's plenty of scope as Circularity Gap has pointed out, that of the 100 billion tonnes of material that's mined or extracted every year, less than 9% of that's recycled or reused, or in other words, it's wasted. So there's plenty of scope for improvement there. And the New Zealand government is on its way to doing that. We have the emissions reduction plan and the draft, well, the National Adaptation Plan. It's actually out now. And these are all part of the setting the direction of the economic plan of searching for a high wage, low emissions economy that provides economic security, or in the parlance, in good times and bad. Key parts of the plan are emissions reduction and the emissions reduction and the National Adaptation Plan. The emissions reduction plan does point out that we need to be more circular in our resource and energy use, have more resource recovery, work harder on developing our bioeconomy and protecting our biodiversity. And also there needs to be a much more climate resilient community. And that feeds into the adaptation plan, which is very much about reducing our vulnerability to climate change and enhancing our adaptive capacity and strengthening resilience. Resilience is very much a popular concept in policy at the moment. It's resilience not only to climate, but also the market concentration and also things like pandemics. And that's where I'll leave it there. Thanks, Zoe.
Thanks very much, Richard, and to all our panelists. We've covered a huge amount of ground already. We've probably got about 10 to 15 minutes just left for questions. So I'll first go to a couple in the Q&A session, and then I've got a few myself if we have time for those at the end. So the first one relates to just thinking about, and I think the person's question has in mind what's been going on with Silicon Valley Bank over the weekend. In terms of the prognosis for interest rates, particularly in the US, do we still think it's likely that the Fed's going to keep hiking, or do we expect that we're going to see a softening in the Fed stance in response to some of the banking sector disruption we've seen over the weekend? Maybe Bevan or Paddy?
Yeah, look, I'll take that one. Oh, sorry, got problems with my throat today. Must be doing too much talking. Look, on Silicon Valley Bank, we don't think that particular failure, or Signature Bank for that matter, are signs of systemic problems in the banking sector. You know, the situations around both of those banks were quite unique and aren't seen in many other banking institutions in the US or around the world. for that matter. What I will say, and I've already touched on it in my comments, and that is these the risks that built up around such a very long period of abnormally low interest rates. And call me old-fashioned if you like, but printing money and negative interest rates will never be conventional monetary policy instruments as far as this old economist is concerned. But I think what it does signal is that we've seen this change and shift from market pricing as the economic data has been better in the US, as the labour market has proved to be more resilient. Sure, that's led to an increase in expectations of the terminal rate in the US, but it's also led to a lengthening of the time frame over which interest rates will stay at that high level. So it's not all about how high rates go from here. We all know about the lags that play out and all of those sorts of things. So look, I think the Fed funds rate will go a little bit higher. The question now is how long it needs to the Fed funds rate needs to stay at that level for it to achieve the Fed's objectives. And I think it's going to be a lot longer. Certainly than what markets had priced just a few weeks ago, was that we would be seeing cuts by the end of this year. I think that we will see cuts at some point through 2024, but probably in the back half. And then there is another question that needs to be asked and answered, and we'll only know this in time as well. And that is that the neutral interest rate in the US may no longer be 2.5. It may no longer be 2 in New Zealand. And so the next interesting thing is when central banks do start cutting rates in 2024 and 2025, how much are they going to be able to cut them? Maybe we have just been through a very arduous process of finding out where the new neutral is. I'll leave my comments there.
Thanks, Bevan. I tend to agree with you about the higher for longer view that you've got there as well. This might be one for you, Paddy. So I think this is meant to be 2% inflation target. And do we think that a 2% inflation target for global central banks is still valid, considering some of the deglobalization trends we're seeing and the higher cost of production?
Yeah, I think it's probably related to the previous comment also. I think we're clearly in a world where population is growing in the emerging world, but is declining with the apart from importing talent into developed countries like our own. So it is very much a policy setting which is at play there. But I think the cost of capital, to the previous question, has gone up, and it's going to take a long time, I think, before we see that cost of capital actually coming down again. And that will be reflected into central bank targets in terms of where they are setting target rates.
Right. Thanks, Paddy.
Can I jump in on that one? Sorry, can I just jump in on that one? Sorry, I'm throwing your organisation out the window. But look, I think it's going to be very challenging for central banks, given those structural inflation pressures. We think it's going to be very low, very difficult for central banks to. They might get it back to 2%, but it might still require a recession to get it back there. The question is, where is that new level of a normal inflation of an inflation rate that is actually sustainable along with whatever the growth rate is going to be? And I think that we are going to see at least inflation starting to average in the top half of target bands rather than, as we've seen over the last few years, the bottom half. And there may even be some further tweaks. And I say further tweaks because remember, the target band in New Zealand has already been shifted twice. I'm old enough to remember when it was first set, right? 0 to 2%. With a midpoint of 1, then it became 0 to 3 with a midpoint of 1.5. Currently, it's 1 to 3 with a midpoint of 2. So it's gradually been edging up. And look, I think in this recent environment where it's all about interest rate suppression, I worry that we're now going into an environment where it's about growth suppression to keep inflation at 2%. And the question is whether that's politically viable. Now, remember, in New Zealand, the Policy Targets Agreement is a contract between the Minister of Finance and the Governor of the Reserve Bank. So is it politically acceptable to continue to suppress growth to keep inflation at 2? I think that's the next question that we're going to be asking ourselves.
Thanks, Bevan. I'll just move to productivity now because there's a couple of questions in that on that topic, and so maybe these might be ones for you, Richard. I'll try and summarize these. I think both of them are sort of driving at, where are our productivity gains going to come from, particularly in terms of innovation? And, how do we shift away from sort of a primarily agricultural driven economy to a much more tech-led innovation, move up the knowledge curve economy over the next few years?
Sure, thanks. Well, on the first one, I was actually going to mention the startups and the innovation. I mean, one of the biggest issues there is the lack of is the access to capital. That many of these firms find it very hard to find the startup capital, and that goes back to Bevan's point earlier that we buy and sell houses from each other, and that soaks up so much capital that can be going into productive use. And as we start to build much more investment capital that's domesticated, we might be able to have the critical mass for that sort of thing. There are increasing calls for funds or development banks or business growth funds to try and provide some of that seed capital. But of course, the other side of that is many people don't like the government being the ones investing in everything. So we need to find ways where we can get much more blended finance and maybe get the government to pull people in with them to create that investment environment. On the productivity one, I guess I was a bit facetious on that it was all going to be agriculture. I just think people need to realise that you don't really know where the tech development is going to come from. And like the examples of our great technology growth, Xero, it might not have happened if we were not so sparsely distributed, and most towns had their largest businesses some way out of town. That actually being able to see your accountant without leaving the farmhouse actually was a very good thing for Xero. So, don't rule it out that Xero didn't grow first because we're an agricultural, sparsely populated place. The second half of that question, can't remember what it was.
I guess, another piece of it is probably how we move up the productivity chain and how New Zealand increases its productivity more generally. What do we need to be doing from a private and a public point of view?
Yeah, well, I mean, we very much have concentrated on the easy wins, the doing things better, right? Which is small and slow, and probably everyone else has done it before us anyway, so we're adopting. And also, we tend to be in low productivity industries, like, vast numbers of people are employed in retail and tourism and things like that, and your average productivity is that. If we're doing better things, and we saw during COVID, when people weren't going to work in tourism or retail-related industries, the average GDP per hour work jumped up quite a bit. Is because the average worker was in much higher productivity sectors. And while we don't think there should be no one working in retail or accommodation anymore, it is a lesson that actually we need to do better things and move into sectors where we actually they are more productive.
Can you think of an example?
Can I think of an example? Well, yeah, if other service industry jobs are generally much higher productivity, so finance, insurance, administrative services, IT and communication. And the other advantage of these sorts of jobs is they're not dirty, they're not dangerous, and they can be done from anywhere.
Thanks, Richard. I might just switch back to Bevan because I know someone that's quite keen to hear your rationale for how demographics are now inflationary. So over to you to explain.
Yeah, sure. Look, so the conventional wisdom has it that that ageing populations are disinflationary. You know, the theory being that as the population ages, and you've got more and more people saving and not spending. And of course, the poster child for that phenomenon has always been Japan. But look, I've never been able to, I guess, square the circle, if you like, on a combination of things, and that is aging population and rising dependency ratios in a world of virtually zero productivity growth. Yeah, and at the same time, you've got global population still growing. So the question then is, what did happen in Japan? And I think what happened in Japan is two things, and that is that the Japanese population was aging at the same time that China was embarking on its drive to be the factory of the world. And so a lot of the production, a lot of the goods that Japan still required were coming ever cheaper from China. Now I don't think that China is, or we know that China isn't going to play that role in the future, because China is now about self-sufficiency and common prosperity, and has its own demographic challenges now. Even before it's become a rich country, you know, which is even more, you know, challenging for China. But then the other factor that is playing out in Japan too is the fact that you're then looking for the reason for the deflation in Japan, and I think that comes back to wage setting behaviour, in that in general, and I'm overgeneralizing, but it's, you know, the Japanese people are almost too polite to ask for wage increases, and look, you've seen that play out over many decades, and you've even seen the incoming new governor of the Bank of Japan, Professor Ueda, talking about just those factors. He does not see persistent inflationary pressures currently embedded in Japan, and that's because of their wage setting behaviour. So I think, and the short answer, Zoe, is that I think we're going into as some of us now in the developed world catch up with that demographic trend that we've seen in Japan for so long. China isn't going to be there to produce the goods and services at ever cheaper prices that they were there doing previously.
That's great. Thank you, Bevan. And I'm afraid that's us in terms of time for today's session. Look, a huge thank you to all our panelists, Paddy, Bevan and Richard, and thank you all for joining us here today. You'll be able to watch this session recorded after the event, or pass it on if you'd like to your colleagues. Hopefully you all took away something useful from today's session, and thanks very much for joining us. Bye.